From Washington, this is the Macrocast, a podcast brought to you by Penta and Markets Policy Partners.
Good morning. You're listening to the Macrocast. I'm Stratton Kirton, partner at Penta, and joined as always by John Fagan and Brendan Walsh from Markets Policy Partners. We've got a lot going on today and a lot to cover: private sector news, earnings, central bank moves, and of course, checking in on the war in Ukraine. So let's jump right in. John, Brendan, as always, good to have you back.
Great to see you, Stratton. It's terrific to be here. This is January is rapidly coming to a close, and it has, depending on who you talk to, it's either been the fastest month they've ever experienced or the longest, or both. And just a lot has happened, and there's no letting up. We'll talk a little bit about how crowded next week's calendar is, but this week was certainly plenty to go over as well. Earnings this week, I suppose the headliner was probably Tesla. Just been the quarter was better than expected, and just the atmospherics around Elon Musk's
I think that was the biggest. Yeah, he behaved like a normal CEO at the
That's a nice trick to get 11% if you can pull it, I guess.
Yeah, well, you had to behave like a fool for 12 months to drive it down 70% to set the bar that low.
Yeah, just for those of you who haven't been on the Tesla stock wild ride, the top out of the share price was $409 in late 2021, and then got as low as 108 at the outset of this year, and has recovered to
and that high was right before he sent the tweet, "Should I buy Twitter?" So a lot of Tesla, a little to do with Tesla, and a lot to do with him selling $40 billion to buy a social media company.
Yeah, so Tesla brightened the mood. It was Elon Musk trying to dampen concerns about demand, which had been swirling around. Also, discussion about their production capacity. There's a sense that other, the more established car makers are catching up, and they do one thing really, really well, which is make cars and make them, a lot of them, very quickly. And they still do have the huge charger advantage.
Yeah, particularly in the rapid charger.
The rest of the EVs don't really have them, and Tesla just has a nationwide infrastructure on that, which just gives them a massive advantage.
And the price cuts, making those cars.
That's what I was going to say, especially in the broader picture of inflation and deflation. Tesla chose to shrink their margins and cut prices to increase demand, which worked. And a lot of times when a company cuts margins, the market takes it poorly. But I think people were so worried about maybe this Tesla craze is over, and they saw that actually, slightly lower margins, is still leading to high demand, and the market took it pretty well. But I think it's also indicative of just the broader economy, where a lot of the inflation that happened in 2021 and 2022 was companies being able to pass on that to consumers. And so their margins actually expanded. So I think a lot of the story in 2023 is going to be prices coming down, outright deflation in some areas. We went way too high, but a lot of the rest, or we're going to see for the rest of the year, is prices probably stay relatively stable in terms of the input costs, but companies aren't going to be able to pass along what they have been in the past.
Well, so as much as it may hurt Mr. Musk to know it wasn't all about Tesla this week, what did we hear about from some of the other companies reporting earnings? I know we had a few airlines, we had some hardware manufacturers, and some telecom companies. Anything else of note?
So Visa and MasterCard reported, and so they both had relatively fine, very good quarters in terms of the fourth quarter. And their guidance was also that the consumer is holding up very well. But both of them are, kind of being cautious. Visa is seeing a little more because Visa is a little more global than MasterCard. So MasterCard's pulling back a little bit in terms of spend and expecting maybe a little rougher road ahead. But Visa, which is a little more global, and especially throughout Asia, is seeing pretty strong demand, especially for travel.
Yeah, and when you look across some of the other sectors, it's just been disparate, right? Divergent results, strikes and gutters, to quote the Big Lebowski.
Yeah. Even within the same industry,
Yeah, you get like Southwest Airlines, which had a god-awful
shocking
quarter, of course. And then you have American Airlines, which, was filling its planes and knocking the ball out of the park. So, this has really been the story of this earnings season so far. It's still very early days. We only have, 100, I think 143, 150 companies having reported of the S&P 500. So it's still, a lot of miles to go in this. And next week is the most consequential week of earnings season. We've got, a murderer's row, right? It's Apple, Amazon, Alphabet, Meta. We got Ford, GM, ExxonMobil, Starbucks, McDonald's, UPS, Pfizer, Qualcomm, Honeywell, others. This is the make or break week coming up for earnings season. Up until now, it's been kind of, a few positives, a few negatives. I guess Microsoft was one of the other.
I was just going to say, Microsoft's probably indicative of both what's going on in the economy and kind of how the market is thinking about things. Microsoft didn't have a great quarter. They saw a pullback in demand, but a lot of that pullback in demand was just kind of a more normalization of coming out of the pandemic, where Microsoft was a big part of us getting through the pandemic. We needed Teams, we needed their products. Both, we played video games, so they checked a lot of boxes of the pandemic companies. They're seeing a much more normalization where companies ramped up, bought a bunch of stuff. Now they're kind of starting to lay off. So Microsoft's doing fine. The initial reaction, but their guidance was for a slowdown in 2023. And the initial reaction was the stock was down, but then kind of, Tesla kind of got the market going again. And Microsoft is now up, 7-8% from where its lows were. So I think we're seeing a situation in the macro where the data is actually starting to get fairly bad in certain sectors. But the market, the equity market, is starting to look through it and deciding, okay, maybe we've seen the worst of it. And now we can start thinking about 2024 earnings rather than getting caught up in how crappy 2023 could be.
So I think that's probably a good pivot. You mentioned Microsoft, and then John, you talked about, we have some other big tech companies, giants, reporting next week. Obviously, the other big story of the last 4 to 6 weeks has been some of the layoffs that have been announced. There have been a few layoffs in, some petrochemical manufacturers, but the ones that have really grabbed people's attentions have obviously been, the announcements at Alphabet, at Microsoft. So what's going on there?
Yeah, it's what people are calling sort of the fleece vest recession, right? Or the Patagonia vest recession. It's the tech workers, the investment banks and so forth. These are the ones that are cutting headcount. And, it's probably, it's a very jarring thing. It's tough for people to do. There are a lot of, discussions about what's the right way to announce this and the right way to do it in a way that's, humane. And we can debate that all day. But, the reality is that the tech companies are, they're looking to cut costs. They're preparing for some leaner quarters. They had a huge boom through the pandemic, as Brendan alluded to. And, this is just, this is part of the cycle, sadly. And
but they're not cutting programmers. That's still, they hog them up as much as they possibly can. What they did is they massively ramped up the sales and marketing, and those are the jobs that are being cut from the tech sector, not the guys that actually make the tech.
And certainly it's still tough to see that kind of, the dissonance between the announcements of all these layoffs getting headlines and then the labor market data, which still comes in really strong. We had, you'd need a magnifying glass to find, these surge of layoffs in the weekly claims for new unemployment claims, which came down a lot. So there's,
and then the JOLTS data is also showing that, the corporate America has started to lay off. Small businesses are on a hiring spree. They were the ones that, really got destroyed during the pandemic, that actually kind of shut down and then have seen a labor shortage. So in the last year, 4 to 5 people that have been hired at small businesses. And I mean, unless we go into recession, I'm not sure why that's going to stop, because they still find a shortage of workers. So the Fed has an interesting dynamic there, where they want to slow things, but we still kind of do have a labor shortage. So there was just an interesting piece out from the University of Texas and the Chicago Fed so I always say that you can explain 80% of most stuff from demographics, and we just haven't been looking at the demographics when we're talking about this labor shortage. It's entirely predictable. The baby boomers are starting to retire. They're the largest part of it. They're not coming back. And then we've had this trend of young white, not necessarily white, but young men, a lot of them dynamic are white, that just are not entering the workforce.
You're right.
And that's been something that's going on for 10, 15 years. So there's no reason necessarily to think that will change. So we really only probably 800,000 jobs short of where we would have been if we didn't go through this pandemic. It's not like there's 5 million people out there that are waiting to come back. And a lot of the Fed's, reasoning in terms of needing to keep raising rates is that we need to make things so bad that these 5 million people come back to work. And I think that logic is wrong. There's only 800,000. And also from a political standpoint, all these people that keep getting dropped off at my neighbor, the vice president's office, is exactly what we need.
Right. Well, not to mention that, you're right. It made me think of legal immigration too, and that the process and the application of visa, right? It's slowed down massively over the course of the pandemic and hasn't really picked back up to pre-pandemic levels. We see
Canada that they attract highly educated. That's what they want. They make it easy for us to come. We in the last 6 years have made it difficult for highly educated people. And we know what the numbers are. For every H8 visa, it creates 2.5 jobs. So the solution is easy. We just need immigration reform, but I'm not sure.
The solution is easy. We just need immigration reform.
This Congress will get right on it.
Everyone's got the super majorities, right?
All right. Well, maybe that's a good pivot. Let's talk about the other big news this week, obviously, was GDP. I think we all saw the headlines, but what did you guys read out of it?
I think that so it was interesting that the headline numbers looked pretty good, but a lot of that had to do with inventory builds. If you actually kind of take the core of what our economy is, and we're a consumption economy, that only advanced 0.2%. So there are signs that the consumer is pulling back. And that is also both through the earnings season and also the kind of monthly data. We're seeing the consumer slow, but also the savings rate. We just got some data today, personal spending and income, and the savings rate ticked up. So I think the consumer both is pulling back, seeing every time you turn on the TV, you see that we're going to recession. So while the headline number was 2% or above, the reality is the first half of the year, we're going through a slowdown. We'll probably have some potentially negative prints. That doesn't necessarily mean we're in a recession, but the overall GDP numbers may be negative. We'll see then what the second half of the year looks like. And I think a lot of that has to do with we have a Fed meeting on next Wednesday and Thursday, and whether they decide to follow the Bank of Canada and kind of pull back on
That's going to be my question.
Hike, or whether they decide to keep going headfirst into the fog.
Well, and it seems like, what's your reaction? It seems like the consensus out there now is it is going to be 25 basis points. And so do you think it's going to be...
John, what's priced in now?
25 basis points. I mean, it's now...
But also going forward.
There's, so basically the market is futures markets are kind of split between one more 25 basis point hike or two more. Basically you get the final kiss goodbye potentially in March. That's sort of where financial markets are priced. That would take, basically that leaves rates, at 5%. And, you end up with and that's where, and right there is kind of where the Fed and the markets really diverge, right? Fed projections are still, and you still hear this, we've got to get above 5. We want to get above. The rationale is a little foggy. The inflation's higher than target, but of course it's higher than target, but it's trending in the right direction. But you've got a lot more divergence in the voices on the FOMC, and so you do have the more cautious among them, backing very, clearly backing 25 basis point rate hike, and not a lot of clarity as to how high they need to go. And then it's really the back half of the year where markets are beginning to they continue to price in rate cuts through the later part of 2023 and into 2024, and the Federal Reserve is telling you that they are, they're not going to do that. They're going to keep rates at the plateau at their highs, for an extended period until, the job is done, or they feel, utterly confident that they can get inflation back into its box, into its target of 2%. And that really is, there's, no matter how good the data has been, when you get really good data in the US, when you get really hawkish sounding Fed speak, it hasn't moved the needle at all on really where futures are. Yeah. And so that has just been so consistent. And so, our view is basically like,
So John, interesting data point is since the late summer when Powell gave his hawkish Jackson Hole speech, the S&P is basically flat. We might be slightly up now. Rates are back down below where they were. The dollar is significantly weakened, and emerging markets have outperformed.
Yeah, financial conditions measured by the Bloomberg Financial Conditions Index are as loose as they've been since February of last year, when the Fed was really just beginning the steepest part of their hiking cycle. This is something that, Fed officials may be fretting about, but essentially, the markets have shown that they are now like, they're like Missouri. They're in the show me state, right? You got to, the Fed's got to show me that they really are going to, in the face of slowing growth, which everybody expects, hold rates at 5 or maybe even above 5% through a deteriorating economic environment when inflation is what seems to be cooling rapidly. And the markets just don't believe it, and they're telling, they're acting like the man from Missouri. You got to show me.
Well, and with that, let's take a short break. And when we come back, I think we'll discuss maybe some moves in the core economic team from the Biden administration, and then check in on Russia's war in Ukraine.
Every 2 weeks, Penta measures U.S. adults' feelings and expectations toward the economy. The Civic Science Economic Sentiment Index, powered by Penta, accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us at pentagroup.co.
All right, and we're back with the Macrocast. Let's get into the latest updates. All right, guys, this feels like maybe a little People magazine for the Macrocast, but lots of speculation on some moves in the Biden administration and their economic leadership team. I mean, we know Brian Deese is going to leave at some point, but when? But what have we heard about his potential replacements?
Yeah, Lael Brainerd is getting all the press these days for the her a potential move to the to head up the National Economic Council. There have been over the years there have been a lot of different discussions about Brainerd's trajectory. There was a lot of expectation that, if you go way back, the Clinton, the purported Clinton administration that was coming in that was supposed to come in 2016, according to a lot of the polls in the lead up to that race. She was the favorite for Treasury Secretary. And when Biden won in 2020, again, her name came up, bubbled definitely up toward the top of the list for Treasury Secretary. Obviously, she had the stint at Undersecretary of International Affairs, which is, a very powerful post within the Treasury Department, very prominent post. And so, the idea that, that perhaps Treasury Secretary Yellen would be on her way out after a couple of years and leave the seat open for somebody else. There was speculation about where, who might fill that seat. And now we've got the NEC in the mix. So, it's not an easy it's not an easy call. The Fed vice chair, right, versus NEC director. I mean, the NEC directorship that's a grueling task. It's also a dead end job by design. You're not going to retire as NEC director. You got to have.
Bernanke, I think our last few Fed chairs were NEC, right?
So there's clearly a lot of overlap in these roles, no question about it, and and Janet Yellen being a clear example of that, having headed up both the Fed and the Treasury. So it's but the idea, the headlines coming in that Janet Yellen is being is going to be the protagonist in negotiations with Capitol Hill over the debt ceiling, and that's her going to be sort of her final rodeo as Treasury Secretary, according to some of the scuttlebutt around town. That makes sense. She's a very trustworthy figure, and she's someone that to the extent that you can get anybody to agree on Capitol Hill these days, is someone that has relatively unimpeachable credentials, and might be able to get some of the moderates on the GOP to sort of see the potential downside to the playing chicken with the debt ceiling. So it's. I don't think it necessarily changes the policy all that much, in terms of the broad brushstrokes. I think the Biden administration's economic policies are now going to be about execution. The legislative sprint is over, at least for now, and nobody's looking past 2024 at this point. So it's a steady hand on the tiller kind of couple of years here where. Not a lot of legislation, but a lot of execution, and some drama over the debt ceiling that needs to get solved.
Right, but Yellen's also been instrumental in the Russian oil price cap. So That's another part of, I think, why Biden wanted her to stay on, and why she might stay on, throughout the whole, last 2 years of the Biden administration, depending on how the war in Ukraine progresses.
Yeah, it seems to be the commentary is that it's working better than expected. There were a lot of critics that said it wasn't going to do what it said it was supposed to do, but it seems like that has been the case. There have been some factors that have maybe helped its case, particularly like the warm winter in Europe.
Oil prices came down.
Prices came down. Yeah.
Right. I was going to say this is a perfect pivot, but, I think part of it is by design. Part of it is lucky coincidence. But yeah, I think earlier this month, actually, at the beginning of January, the Russian government released their projections for oil and gas revenue, which I think everybody probably assumes and rightly assumes is very important to government revenues. And I think officially they said revenue's down 23%. Independent experts I'd say that probably means it's down over 30%. And just some individual tangible proof points is Gazprom's revenues down almost 50% last year. At a time when Russia really thought natural gas was, their secret lever to put the political pressure on.
We're on our way back to $2 on natural gas. It's amazing.
Well, and it's like and oil is, $80 a barrel, which is, a little high.
Fairly normal.
Yeah, but fairly normal, down a lot. And then, we've received beyond just the G7 price cap. We've received reports that, sort of the leverage that the Russians thought they had with, the Chinese and the Indians as a backstop to the Europeans, Americans. Well, it turns out the Chinese and the Indians are negotiating for really cheap Russian oil, and they're buying it at $48 a barrel.
Why would they line up to pay more for it when they know they've got you over a barrel?
Over a barrel. But obviously some other big news on the military front there this week. We saw, I guess sort of a lagging indicator from the Munich Security Conference. First, the Americans agreeing to send Abrams tanks and forcing the Germans to send Leopard's tanks. Anything to think about there?
How much of a surprise do you think that was to Germany, that we kind of called their bluff?
In some ways, I feel like it was a surprise because I think they also realized the Abrams tanks, which run on jet fuel, not diesel, are going to be logistically just a lot more difficult to supply in a way that makes a difference on the battlefield. But this seems to be sort of the rhythm of the entire, the war and the munitions debate between the US and European allies is, they're sort of dragging the feet, trying to call the bluff. And then, Americans making moves, whether it's on the Abrams or the Patriot missile systems, by Ukrainian standards, all way too late, but eventually getting there.
And how much of a role do you think it'll play, in the war?
I think people who I've talked to who are a lot smarter than me on this, they've pointed out the most important thing is, javelins are really great for taking out 1,400 Russian tanks. They're not really great for reclaiming territory occupied by Russia. And that's where the tanks come in is, a return to mobility, whether it's, the occupied eastern regions, or there's a lot of speculation, that if they're able to hold off a Russian offensive in the east, which everybody expects in the spring as, the conscripts come in, that, they can make a drive to the south and sever Ukraine. And so I think that's a big thing to happen. But, the other thing I think we talked about this maybe at the end of the last year, but I was just checking in too, is I was thinking about the other economic leverage here Russia had was food prices, obviously impacted by global energy prices, but also the lack of crops coming out of Ukraine. And it's the same story as oil. It's higher than it was before the war, but down 30% from the peak. And, with the luck of weather, oil prices and food prices coming down, I'm just curious from an economic standpoint here, what Russia's end game or out is.
Yeah, I mean, from just on the food issue, clearly Russia is going to, with that approach, it was clear that they were going to hurt emerging markets, the Middle East, they were going to upset some potential allies or some, countries that are, stepping to the plate to support them. China, India, these are countries that have food security in, among their priorities. And so, clearly Russia playing that card was not popular with emerging markets and some of its potential supporters and enablers and so forth. So that it's really not clear that they can pull that lever as well. One of the things that we've heard from European officials is they're not that worried about this winter. They're more worried about next winter, the ability to replenish the stocks. And this feeds into that geostrategic question mark, which is that, just as you said, Stratton, that end game. Everybody's almost as nervous about the obviously Russia making gains and making it having a big success in a spring offensive is kind of the big risk that people are focused on geostrategically. But a secondary one is, what if they lose too fast? A disorderly Russian loss where they're severed by tanks, and Putin is pushed further into a corner, desperation. What do they do to lash out? What do they do to try to regain some initiative? Is that chemical weapons? Is it something that is a truly disturbing and escalatory, even within the already disturbing and distressing context of this conflict? And so that there's just a lot of uncertainties around it.
Yeah, because every time the West gives Ukraine something, Russia's response is, we're going to escalate. But I mean, they're already doing terrible, terrible things. What exactly does escalation mean from where we stand right now?
You really got to circle those, like, chemical weapons, real, they're already terrorizing the populace, but dialing up the terrorism angle on the populace of Ukraine. It's, you hate to speculate and go down the road on these things, but essentially bloody stalemate is now very, is a nice is comparatively a stable equilibrium, which is a horrible thing to say, but that's where we are.
Well, and I'll just add one more thing and then we can wrap up. But, the thing I always remind people is Russia under Putin is terrifying. A destabilized Russia, where the central government falls apart, is a nightmare. I mean, it has the largest stock of nuclear weapons in the world, at least 6,000 that we know of. It's no matter who's in charge, you obviously want them out of Ukraine and want the war stopped. You also don't want a government that disappears overnight.
It's an incredible point. Yeah. Before he invaded, he was kind of our frenemy. he would mess things up and, do some bad stuff, but he kept a very unstable, dying society, contained, and not in anarchy, which could happen if something happens to him.
Well, on that high note, what should we look for next week? What's coming up?
Big week. We got pretty much every central bank. We have the Fed, we have the Bank of England, and the ECB. I don't know. Is it good that they schedule? I mean, it's not that they coordinated, but should we stagger them a little, or is it good that we do them all in the same week?
Rip the Band-Aid off. They should all announce at the same time.
Right.
Fed, European Central Bank, Bank of England. We've got the U.S. jobs report.
Yeah, and then we close on Friday with the jobs report.
Yep. And,
which that'll be an interesting one, because that's going to be January, the month where we heard a lot of these announced layoffs. Mm-hmm. I think that we'll get some challenger data next week, which they follow the number of announced layoffs, and I think that number is going to be one of the biggest we've seen in really since the 2008. So then we'll find out whether the interesting thing about the claims number is the low claims doesn't necessarily mean that people aren't getting laid off.
Right.
But you also see that the slowdown in hiring. That's what shows it up in the jobs number. If no one hired, obviously the number is zero, and that's disappointing. So the labor market could be much weaker than the initial jobless claims are indicating.
All right. Well, gentlemen, fascinating conversation as always. Thank you to everyone for listening to the Macrocast. I'm Stratton Kirton with Penta, and thanks as always to John Fagan and Brendan Walsh of Markets Policy Partners for hosting with me. Hope everyone has a great weekend.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.